investing for growth. It's something we all think about, right? And
Yeah.
sometimes maybe the most compelling potential opportunities. They aren't in the places we look every single day. Actually, according to some recent analysis, there might be, well, one source is calling it a fire sale happening in emerging markets right now.
That phrase definitely gets your attention, doesn't it? I mean, the potential for higher growth rates compared to, say, developed economies, that's a big draw, no doubt about it. But, well, as it usually is in investing, especially in markets that are so dynamic, constantly changing, having a really clear picture of what's going on underneath, that's absolutely crucial.
Couldn't agree more. So for this deep dive, we're going global. Specifically, we're exploring how investors here in the U.S. can, potentially tap into that growth potential in emerging markets.
Yeah.
And the way we're looking at it is through U.S.-listed exchange-traded funds, or ETFs.
Right.
We've got a pretty good stack of sources here that let us look at this from, well, a few different angles. We've got analysis from Fidelity, which is great because it helps us navigate the, let's be honest, often complicated world of tax implications for ETFs. And there's some surprising twists there, especially for emerging markets.
Those tax rules can be tricky.
Then Saxo Bank gives us a solid framework for actually building a diverse ETF portfolio, from the ground up. And they also help us spot some common traps people fall into.
Good, practical stuff.
Yep. And Investopedia. They dive deep into the specific risks, the unique ones, sometimes the ones you don't immediately think about, that come with investing in emerging economies.
Which is critical. You need to know the downside.
Absolutely. And finally, TipRanks gives us a really practical side-by-side comparison of two of the big players in this space.
Right.
VWO, that's the Vanguard FTSE Emerging Markets ETF.
And EM, the iShares MSCI Emerging Markets ETF.
Exactly. So two major options head-to-head.
That sounds like a really comprehensive look. We can go from the basics, like why even use ETFs for diversification, then zoom into the specific challenges, the higher risks you find in emerging markets, and then finish up with a really practical look at the actual products out there, VWO and EEM, and how they really stack up against each other.
That's the plan. Our mission here is really to boil down all this key info from these different sources for you, the listener. We want to help you cut through the noise, basically, and walk away with a clearer sense of the potential upside people are talking about, but also the really significant risks you absolutely have to know about. And the practical side, how to use ETFs for this, the kind of surprising tax stuff, and the real differences between funds like EM and VWO.
Giving people the tools to think about it for themselves.
Exactly, giving you the knowledge to navigate this part of the investment world with a bit more confidence. Okay, let's unpack this. Maybe start with the basics. ETFs themselves.
Let's do it. Yeah, as Saxo Bank points out, ETFs have really become a cornerstone for tons of investors. I mean, from complete beginners all the way up to big institutions. At their heart, an ETF is basically just a collection of assets. Could be stocks, bonds, commodities, sometimes even things like real estate, all bundled into one single fund. But the key thing, the thing that makes it an ETF, is that this fund trades on stock exchanges all day long, just like a share of Apple or Google.
Ah, okay. So you get that mix of assets like a mutual fund,
Right.
but you can trade it instantly, like a stock, that combination.
Exactly. It gives you this really powerful combo. The diversification you get from holding a whole basket of stuff, combined with the flexibility of trading a single stock whenever the market's open.
So instead of figuring out which, hundreds of emerging market stocks to buy individually,
Right. Forget that.
you can just buy one share of an EM ETF, and boom, you've got exposure to that whole basket. Simple idea, but as our listeners know, a pretty sophisticated tool behind the scenes.
Definitely. And the sources, especially Saxo Bank, highlight quite a few reasons why investors flock to ETFs.
Yeah, let's break those down. Cost seems to be a big one.
Oh, absolutely. Cost efficiency is huge, especially if you're investing for the long haul. ETFs, generally speaking, tend to have significantly lower expense ratios than a lot of traditional mutual funds, particularly the actively managed ones.
Why is that usually?
Well, a huge number of ETFs are passively managed. They're not trying to beat the market. They're just trying to track a market index, like the S&P 500, or in our case, maybe an emerging markets index. So you don't need these big, expensive teams of analysts and managers constantly buying and selling stocks, trying to pick winners. That passive approach keeps the operating costs way down.
And those savings get passed to the investor.
Exactly. Lower fees. And over, 10, 20, 30 years. Even a small difference in fees can make a massive difference to your final returns because of compounding. It really adds up.
Okay, low cost. That makes sense. And you mentioned the trading flexibility. That's different from mutual funds too, right? They only price once a day.
Precisely. With a mutual fund, you put in your buy or sell order, and it gets executed at the net asset value, the NAV, calculated after the market closes. That's it. The market is open at whatever the current market price is. That gives you real-time flexibility.
So if you see something happening midday and want to react,
You can. Now, for most long-term buy and hold investors, maybe that intraday trading isn't the main reason they use ETFs. But still, that liquidity, knowing you can get in or out easily at a known price, that's definitely an advantage. Price transparency, too.
right. And then maybe the biggest reason people start with ETFs, diversification.
Yeah, diversification is, I'd argue, the most powerful benefit, especially for individual investors trying to get broad market exposure without buying tons of individual stocks.
Yeah.
You buy one share of a broadly diversified ETF, say one that tracks a global stock index, and instantly your money is spread across hundreds, maybe thousands of different companies.
Across different sectors, different countries.
Exactly, all inside that one ETF. It's just a remarkably efficient way to manage certain kinds of risk.
And the risk it really helps with is that company-specific stuff, right? Unsystematic risk.
Exactly. Unsystematic risk or specific risk, diversifiable risk, it's all the same idea. It's the risk tied to one particular company having a bad quarter, or one specific industry facing headwinds, or maybe even one country hitting an economic rough patch. If you own just one or two stocks and something bad happens to them, your whole investment can take a big hit.
Yeah.
But if you own an ETF holding hundreds of stocks across different sectors and places, the poor performance of one or even a few holdings gets diluted. It's buffered by everything else in the fund.
So losses in, say, tech might be offset by gains in healthcare or consumer staples within the same fund.
Precisely. It smooths out the ride. Now, it doesn't get rid of all risk. There's still systematic risk, market risk things like a global recession or rising interest rates that affect almost everything. You can't diversify that away completely. But for tackling that company-specific or sector-specific risk, ETFs are fantastic.
And they're easy to access too, the source says.
Yeah, accessibility is another big plus. You can often buy ETFs with pretty low minimum investments, sometimes just the price of a single share. And lots of brokers now offer fractional shares, so you can start building a portfolio even with, relatively small amounts of money.
Right. You don't need thousands to get started.
Not at all. Plus, there's just this huge universe of ETFs out there now. You can get really specific if you want to target, say, a particular sector like clean energy or a geographic region like emerging markets or even an investment theme. You can get that targeted exposure but still benefit from diversification within that specific area.
Okay, so ETFs are great tools for diversification. But Saxo Bank also makes a point that just owning one ETF isn't necessarily the end of the story, right? You need to think about diversifying your whole portfolio.
That's such a critical point, and yeah, sometimes people miss it. They buy one super diversified global stock ETF and think, okay, I'm diversified. And while that fund is diversified, your entire investment portfolio might not be if that's all you own. True portfolio resilience usually comes from diversifying across different types of assets.
Like stocks and bonds.
Exactly. Stocks, bonds, maybe some alternatives like real estate or commodities, potentially different investment styles too, like growth versus value, and definitely across different geographies and sectors. A single ETF, even a global one, gives you diversification within its specific mandate. But building a portfolio of different ETFs lets you achieve that strategic diversification across these broader categories.
So maybe you have one ETF for U.S. stocks, another for international developed stocks, one for emerging markets like we're discussing, and then maybe a broad bond ETF, something like that.
Precisely. That kind of multi-ETF approach helps manage overall risk better because these different asset classes and regions don't always move in perfect sync. As the source mentions, it lets you capture opportunities from different parts of the global economy. Maybe emerging markets are booming while the U.S. is slowing down, or maybe bonds provide stability when the stock market gets choppy.
You benefit from different cycles.
Right. And diversified ETFs make building this kind of portfolio much simpler. A global equity fund gives you the stocks. A multi-asset fund might package stocks, bonds, and commodities together. You combine these building blocks.
And the key is you're not overly reliant on just one thing doing well.
Exactly. And the source makes clear you don't need to be some huge institution to do this anymore. Using readily available low-cost ETFs like all-world funds or sector balance funds makes this kind of sophisticated diversification really accessible.
Okay, that makes sense. We get the tools ETFs and why diversification across the whole portfolio is crucial. But how do you actually do it? How do you build a portfolio that fits you? Saxo Bank lays out a process, doesn't it?
They do. It's a very logical, step-by-step approach. And the absolute first step, honestly, the most important one for any kind of investing, is defining your goals and figuring out your risk tolerance.
The classic starting point.
It has to be. What are you actually trying to achieve with this money? Are you saving for retirement in 30 years, a house down payment in 5, just trying to generate some income right now? And, just as important, how much market fluctuation can you stomach? Would a 20% drop in your portfolio make you panic and sell everything, or can you ride it out?
Knowing yourself as an investor.
Exactly. Your answers to those questions, your goals, your time horizon, your comfort level with risk, they form the foundation for everything else.
Okay, step 1, goals and risk tolerance. Got it. What's next?
Step 2 is deciding on your asset allocation. This is where you figure out how to slice up your investment pie. What percentage goes into stocks? What percentage into bonds? Maybe a slice for alternatives. And this allocation flows directly from step 1. Generally, longer time horizon, higher risk tolerance. You'll probably lean more heavily into stocks, which have higher growth potential, but also more volatility.
And shorter time horizon, lower risk tolerance. More bonds.
Right. More bonds for stability and capital preservation.
Saxo Bank gives some examples, right? Conservative, balanced, aggressive. Can you walk us through those?
Sure. The conservative portfolio is all about, well, playing it safe, minimizing risk, preserving capital. This is often a good fit for someone maybe investing for a short-term goal just a few years out, or someone nearing or in retirement who really needs to protect what they've saved. The example allocation they give might be something like 60% in bond ETFs, think stable government bonds, maybe some investment-grade corporate bonds, then maybe 30% in stock ETFs, but focused on, say, large, stable companies, maybe dividend payers.
Less volatile stocks.
Exactly, and perhaps a small 10% slice in something like multi-asset funds or real estate ETFs, just for a bit more diversification without adding much risk. The main goal here is stability, maybe some income, not shooting for the moon on growth.
Okay, that makes sense for someone needing stability. What about the middle path?
That's the balanced portfolio. It tries to strike a balance, blending decent growth potential with a reasonable amount of risk control. This often suits investors with a medium-term horizon, maybe 5 to 15 years out, and who are okay with some market bumps along the way but don't want extreme volatility. A possible allocation here could be, say, 50% in stock ETFs, maybe a mix, some broad global stock exposure, maybe some specific sectors for a bit more growth kick. Then 40% in bond ETFs, perhaps a mix of government and corporate bonds.
Still a significant bond allocation for stability.
Right. And then maybe 10% in alternatives or multi-asset ETFs could include commodities, real estate, just to add another layer of diversification that might behave differently from stocks and bonds. It's about finding that middle ground between growth and protection.
Okay. And for the risk takers with time on their side?
That's the aggressive portfolio. This one is explicitly designed to go for higher returns, typically over a long time horizon, think 20 years or more. It assumes the investor is comfortable riding out potentially big market swings. So the allocation leans heavily into stocks, maybe 80% in stock ETFs. This could be broad global funds, but also potentially more in small cap stocks for higher growth. And definitely, relevant to our discussion, a potentially larger slice in emerging market ETFs.
Because they offer that higher growth potential even with the higher risk.
Exactly. Then maybe only 10% in bond ETFs, perhaps focusing on higher yield bonds or shorter duration ones that are less sensitive to interest rate changes. And the final 10% might go into thematic or sector ETFs targeting areas like tech or clean energy or whatever high growth theme you believe in. The focus is clearly on maximizing growth, accepting higher volatility as part of the deal.
And the source mentions you can tweak these, right? Like adding ESG funds if that's important to you.
Oh, absolutely. These are just starting points, templates. You can definitely customize them. Maybe you want more international exposure or less. Maybe you want to incorporate ESG factors. It's all about tailoring it to your specific situation.
Okay, so you've got your asset allocation figured out. Step 3 is picking a construction strategy. What does that mean?
It's about how you put the pieces together using those ETFs you plan to select. They mention a few ways to think about it. One popular one is the core and satellite approach.
Core and satellite.
Yeah. You build a large, stable core for your portfolio using broad, low-cost market index ETFs. Maybe a total U.S. stock market ETF and a total international stock ETF make up 70–80% of your portfolio. That's your foundation. Then you add smaller, more targeted positions as satellites around that core. These could be specific sector ETFs, maybe a country ETF, or perhaps an emerging markets ETF like VWO or EM. These satellites are where you might try to add a bit of extra return or tilt your portfolio towards areas you're optimistic about.
So the core keeps you grounded, and the satellites are for tactical bets or specific exposures.
Pretty much. It gives you broad diversification, but still lets you express some specific views. Another approach they mention is equal weighting. Super simple. You just decide on, say, 5 ETFs you want to hold, and you put 20% of your money in each.
Easy to implement.
Very. And it ensures no single position dominates unless it dramatically outperforms. Then there's goal-based construction. Here, you literally pick ETFs designed to help you meet a specific goal. If income is your main goal, you might overweight dividend ETFs. If growth is paramount, you focus on growth-oriented funds.
Matching the tool to the job.
Exactly.
All right, strategy chosen. Step 4 is the fun part, actually picking the ETFs. What should people look for?
The source boils it down to a few key things. First, back to costs. Low expense ratios. We've hammered this point, but it's critical for long-term success. Fees directly reduce your return.
Minimize those fees. What else?
Second, high liquidity. You want ETFs that trade frequently, with lots of buyers and sellers. This usually means tighter bid-ask spreads the difference between the buying and selling price so you're not losing money just getting in and out. It makes trading easier and cheaper.
Makes sense. And the holdings.
Right. Third, make sure the ETF actually holds what you think it holds and provides the diversified exposure you're looking for. Does it track a sensible index? Does it cover the market segment like large cap EM or all cap EM you intended? Does it align with your overall strategy?
So low cost, easy to trade, does what it says on the tin.
Got it.
And step 5 is not setting and forgetting.
Definitely not. Step 5 is crucial. Review and rebalance your portfolio regularly. This is ongoing maintenance.
Why is rebalancing so important?
Because over time, as different parts of your portfolio perform differently, your original asset allocation will drift. Let's say stocks have a great run and bonds are flat. Your portfolio might shift from a 60-40 stock bond mix to maybe 70-30.
Making it riskier than you originally planned.
Exactly. Or it could go the other way if stocks slump.
Right.
Rebalancing is the process of bringing your portfolio back to your target allocation. It usually involves selling some of the assets that have grown too large and buying more of the assets that have shrunk.
It forces you to sell high and buy low in a disciplined way.
That's a great way to put it. It enforces discipline.
How often should you do it? Annually.
There are a couple of main ways. You can use a calendar-based approach, say, review and rebalance every year on your birthday or every 6 months. Simple, easy to remember. Or you can use a threshold-based approach. You set rules like, if any asset class drifts more than 5% or 10% away from its target percentage, I'll rebalance. This might lead to more frequent rebalancing in volatile markets and less frequent in calm ones. Either method works. The key is just doing it periodically.
Okay, that 5-step process: goals, risk, allocation, strategy, selection, rebalance seems like a really solid roadmap. But Saxo Bank also warned about some common mistakes, right? Pitfalls to avoid.
They did, and these are things that can really trip investors up, even if they're using ETFs. The first one is overconcentration.
Oh, wait, aren't ETFs diversified?
The individual ETF usually is, yes, but you can still end up over-concentrated at the portfolio level. Imagine you buy a tech sector ETF, a communication services ETF, and a consumer discretionary ETF because you like those areas.
Okay.
Well, many of the underlying companies in those sectors might be very sensitive to the same economic factors or trends. So even though you hold 3 different ETFs, your portfolio might still be heavily bet on one particular part of the market doing well. You need to look at the overall balance across truly different economic drivers.
Looking at the underlying correlations, not just the EPF label.
Exactly. Another big mistake is ignoring costs. We talked about expense ratios, but also watch out for things like trading commissions, though many brokers are 0 commission now. And those bid-ask spreads on less liquid ETFs, every little bit counts and eats into your returns.
Right, costs matter. What else?
Overlapping ETFs. This happens more than you'd think. Someone might buy an S&P 500 ETF and also a large cap growth ETF and maybe a total U.S. market ETF.
And they end up owning Apple and Microsoft 3 times over.
Pretty much. You're just buying the same stocks multiple times through different wrappers. It adds complexity, maybe extra costs, but doesn't really improve your diversification.
Yeah.
Using portfolio analysis tools can help spot this kind of overlap.
Okay, avoid duplication. What about chasing hot funds?
Ah, the classic chasing performance. This is buying an ETF simply because it's gone up a lot recently, hoping it keeps going up, and maybe selling funds that have done poorly.
Trying to time the market.
Exactly.
Yeah.
And it usually leads to buying high and selling low, the exact opposite of what you want to do. Sticking to your long-term plan and asset allocation is almost always better than jumping on bandwagons.
Discipline over emotion.
Absolutely. And the last mistake ties back to step 5.
Not rebalancing.
Right, not rebalancing.
Yeah.
If you don't periodically bring your portfolio back in line with your targets, it can drift significantly. You might end up taking way more risk than you intended, or maybe become too conservative and miss out on potential growth, all without consciously making that decision.
So that regular maintenance is key to staying on track.
Yeah.
Okay, that gives us a really strong foundation on ETFs, diversification, building a portfolio, and what not to do. Now let's pivot specifically to emerging markets.
Yeah.
Investopedia lays out some risks here that sound, well, quite different from investing in the US or Europe.
Yeah, this section from Investopedia is super important because while everyone gets excited about the potential for higher returns in emerging markets, faster economic growth, maybe younger populations, you absolutely have to go in with your eyes wide open about the unique and often much higher risks. It's always this trade-off, isn't it? Trying to grab that growth potential while dodging the volatility and the specific downsides. And they make a good point. The extra return you might get for taking these risks, it's often just an estimate, much harder to pin down than in developed markets.
Okay, so what are some of these specific amplified risks in EM?
Well, the first one they detail is foreign exchange rate risk or currency risk. This is a big one.
How does that work?
Okay, so you buy shares in, say, a Brazilian company using an ETF. The company does well, the stock price goes up in Brazilian real, great, but you're a U.S. investor. Eventually, you want U.S. dollars. If during the time you held that investment, the Brazilian real weakened against the U.S. dollar, that depreciation eats into your returns when you convert back.
So the stock could go up 10%, but if the currency falls 15% against the dollar.
You've actually lost money in dollar terms. Even though the stock itself did well, it adds this whole other layer of volatility you have to consider on top of the actual investment's performance.
Wow, okay, currency risk. What else?
Yeah, something a bit more technical, non-normal distributions. In developed markets, financial models often kind of assume stock returns follow a nice, predictable bell curve, a normal distribution. Lots of risk models are built on that. But emerging markets, their returns often don't fit that neat pattern. They might have fatter tails, meaning extreme events, big gains, or big losses happen more often than the standard models predict.
So the usual risk gauges might underestimate the real potential for big swings.
That's the concern. Plus, these economies are often changing so rapidly, structurally changing, that using historical data to predict future risk or correlations can be less reliable than in more stable developed markets. The past might not be a great guide.
Makes modeling tricky. What about rules and regulations?
Yeah, they point to lax insider trading restrictions. Now, most EM countries have laws against insider trading on paper, but the enforcement, it can be much weaker, less consistent than in, say, the US. This can create an uneven playing field. Prices might get pushed around by people trading on private information, not just public fundamentals. It makes it harder to trust that the market price reflects the true value and allows those with connections to potentially profit unfairly.
That sounds like it can definitely shake investor confidence.
It introduces an element of unpredictability, for sure. Then there's a lack of liquidity.
Meaning it's harder to buy and sell.
Generally, yes. Emerging stock markets tend to be less liquid than developed ones. Liquidity just means how easily you can trade an asset without moving the price too much. In less liquid markets, there might be fewer buyers and sellers around at any given moment. This can make it slower or harder to execute your trades, especially if you're dealing with large amounts.
And potentially more expensive.
Yes. It often leads to wider bid-ask, spreads that gap between the buying and selling price. So your transaction costs go up. Your broker might have to work harder to find someone to trade with, and you might not get the exact price you see quoted, especially if you need to sell in a hurry. It just adds friction to the process.
Okay, so trading can be slower, costlier, maybe less certain. What about the companies themselves?
Another challenge they highlight is the difficulty raising capital for companies within these markets. Many emerging economies just don't have the super developed, efficient banking and financial systems we see in the US or Europe. This makes it harder for local businesses to get the loans or investment they need to grow to build new factories, develop new products, whatever.
So growth potential might be capped by financing access.
It can be. And when they do raise capital, it's often at a higher cost. investors demand a higher return to compensate for the perceived risks of the market. This higher cost of capital means fewer projects look profitable for the company.
Their hurdle rate is higher.
Exactly. A project that might be a go for a U.S. company with cheap financing might be a no-go for an EM company facing higher borrowing costs. So even with a growing economy, companies might struggle to fully capitalize on it.
Interesting constraint. What about how companies are run? Governance.
That's another big one. Poor corporate governance. The rules and practices around protecting shareholder rights, ensuring management acts in shareholders' best interests. They can be weaker or less enforced in some emerging markets. This might mean management, or sometimes even the government, has more sway over company decisions than minority shareholders do. Things like weak rules on transactions between the company and its major owners, or rules that make it hard to replace underperforming management, can be issues.
So your interest as a small shareholder might not be the top priority.
That's the risk. Now, Investopedia does note that many EMs are improving governance to attract foreign investment, but it's still a factor to be aware of.
And related to weaker governance, maybe weaker oversight. What about financial reporting, bankruptcy risk?
Yeah, they tie that together under increased chances of bankruptcy. Because of potentially weaker governance, less rigorous accounting standards or audits, there's maybe a higher risk that companies could, well, cook the books, misrepresent how profitable they really are.
Until the truth comes out and the stock collapses.
Right. Sudden, nasty surprises. Plus, as we mentioned, companies often face higher borrowing costs in EM. That higher debt burden makes them inherently more vulnerable if business slows down or interest rates rise. It increases the risk of financial distress and bankruptcy.
So the numbers might be less reliable and the financial footing might be less stable.
Again, the source does say things are improving, that the really unstable past is becoming less common, but the relative risk compared to developed markets is still there.
Okay, and then there's the really big unpredictable one, politics.
Yes, political risk. This looms large over emerging markets. It's the uncertainty that comes from potential government actions or just general instability.
Like what kind of actions?
Oh, all sorts. A government could suddenly decide to nationalize an industry, or impose new taxes, or scrap subsidies. They might change regulations affecting foreign investors, or rules about taking resources out of the ground. Maybe they struggle to control inflation.
Stuff that directly hits your investment's value or operations.
Exactly. And in more extreme cases, you could have major political instability, social unrest, even civil conflict, which could just shut down industries or make it impossible to get your money out. It's a type of risk that's often harder to predict or quantify than purely economic factors.
Wow. So on top of all the usual market risks, you've got currency risk, governance risk, liquidity risk, political risk. It's definitely a different ballgame.
It really is. It underscores why EM investing is considered higher risk, higher potential reward. You need to weigh that potential against these very real challenges.
Okay, given all those significant and kind of unique risks, let's bring it back to the practical tool. ETFs. We generally hear ETFs are more tax efficient than mutual funds, right? Especially in regular taxable accounts. How does that idea hold up when we're specifically talking about emerging market ETFs? Fidelity had some really key points here.
This is where it gets super interesting and maybe a bit counterintuitive for some folks because, yes, the general rule is true. ETFs often have a tax advantage over mutual funds in taxable accounts. But emerging market ETFs can be a major exception to that rule.
Okay, why are ETFs usually more tax efficient? Can you recap that quickly?
Sure. It boils down to how they handle investors buying and selling shares, that creation and redemption process, using what are called authorized participants, or APs, usually big institutions. When lots of people want to buy an ETF, the AP gathers the underlying stocks needed and delivers them in kind, meaning they deliver the actual stocks to the ETF manager in exchange for new ETF shares.
So no cash changes hands for the stocks themselves.
Right. And crucially, when people are selling the ETF, the AP buys up ETF shares on the market, takes them to the ETF manager, and receives a basket of the underlying stocks in kind back from the manager. This in-kind exchange means the ETF manager generally doesn't have to sell appreciated stocks within the fund just to meet redemption requests.
Unlike a mutual fund manager, who often does have to sell stocks to raise cash for departing investors.
Exactly. And when a mutual fund manager sells stocks that have gone up in value, it creates a capital gain inside the fund. That gain has to be distributed to all the remaining shareholders, even if you didn't sell anything. That's a taxable event for you.
Okay.
ETFs, by using that in-kind process, mostly avoid creating those internal capital gains distributions. So, as an ETF investor, you typically only pay capital gains tax when you personally sell your ETF shares for a profit. That's the core tax efficiency advantage.
Makes sense. The plumbing is different. But you said EM ETFs can break this rule. How?
Yes, this is the crucial point from Fidelity. Certain international ETFs, and especially emerging market ETFs, can be less tax efficient. Why? It goes back to that in-kind delivery. The problem is many emerging market countries have rules or just market structures that restrict or flat out prohibit delivering securities in kind.
Uh, so the APs can't just hand over a basket of stocks from, say, India or Brazil easily.
Exactly. Or the ETF manager can't easily hand them back out. So when there are a lot of redemptions people selling the EM ETF, the ETF manager might find they can't use the efficient in-kind process. Instead, they might be forced to do what a mutual fund manager does, sell stocks within the ETF portfolio to raise the cash needed to pay the AP for the redeemed shares.
And that internal selling triggers capital gains.
Bingo. It creates capital gains distributions within the ETF, which then get passed through to you, the shareholder, creating a potentially unexpected tax bill, just like with a mutual fund.
Wow. So the very mechanism that makes most ETFs tax efficient can break down for emerging market funds because of local market rules.
Precisely. It fundamentally undermines that key tax advantage. So if you're holding an EM ETF in a taxable account, you might get hit with capital gains distributions even if you haven't sold your shares, which is not what most people expect from an ETF. It's a really important detail to know.
That is a really surprising and important nuance. Are there other types of ETFs that have similar tax issues?
Yeah, Fidelity mentions a couple of others. Leveraged and inverse ETFs, the ones that use derivatives like swaps and futures to get, say, 2x or negative 1x the market return.
Yeah.
Well, those derivatives can't be delivered in kind either, and gains from many of them get taxed under a special IRS rule, the 60/40 rule. Doesn't matter how long you held the ETF, 60% of the gain is treated as long-term capital gain, 40% as short-term ordinary income.
Ouch, that 40% at higher rates hurts.
It can. Plus, those leveraged inverse funds have to rebalance daily, which can generate a lot of taxable events frequently. Commodity ETPs, exchange-traded products that hold futures contracts, like for oil or gold, often fall under that same 60/40 tax rule, too.
So basically, anything using complex derivatives or facing restrictions on in-kind transfers might not follow the standard, simple ETF tax rules.
That's a good way to summarize it. You really need to understand what's underneath the ETF wrapper.
Okay. Fidelity did mention one type of product that's often considered most tax efficient, though, right? ETNs.
Ah, yes, exchange-traded notes, ETNs. They are different.
How so? They trade like ETFs, don't they?
They trade on exchanges like ETFs, yes. But structurally, they're quite different. An ETN isn't a fund holding assets. It's actually a debt note, like a bond, issued by a financial institution, usually a big bank. The ETN promises to pay you the return of a specific index, minus fees, but it doesn't actually own the underlying stocks or bonds in that index.
Okay, so no underlying assets means.
No dividends or interest payments are passed through to you while you hold the ETN. Any income generated by the index components is just factored into the ETN's price or value. This means, generally, you don't receive those potentially taxable distributions year after year like you might with an ETF or mutual fund. The only tax event usually happens when you sell the ETN.
And that's taxed as?
Typically, the entire gain is treated as a long-term capital gain when you sell, regardless of how long you actually held it, which is very favorable.
That sounds incredibly tax efficient, especially for holding in a taxable account. What's the catch? There's always a catch.
The big catch is credit risk. Because the ETN is a debt note from a bank, you're relying on that bank to make good on its promise to pay the index return. If the issuing bank were to go bankrupt,
You could lose your money, even if the index went up.
exactly, you're taking on the creditworthiness risk of the issuer, which is a totally different risk than the market risk you take with an ETF that actually holds the asset. So it's a trade-off. But purely from that perspective of avoiding annual distributions while holding, ETNs can be very attractive.
Fascinating. So the key takeaway on taxes is ETFs are usually tax efficient, but don't assume. Especially with international emerging market or derivative-based funds, you need to check if that in-kind mechanism works properly. Otherwise, you might get unexpected tax bills.
Absolutely. The details of the fund structure and the specific market it invests in really matter for tax efficiency. Devil's in the details.
All right. We've covered ETFs, diversification, portfolio building, the unique EM risks, the tax wrinkles. Now let's get concrete and apply this to VWO versus EEM. TipRanks gives us that head-to-head, and they start by kind of reinforcing the why now for looking at emerging markets.
Yeah, they set the stage, again, presenting that investment case for considering EM right now, especially given where other markets are. A key piece of data they point to is economic growth forecasts. Like the IMF is projecting significantly higher real GDP growth for emerging and developing economies. They cite 4.1% for 2024 compared to much slower growth, maybe 1.4% for advanced economies like the US.
So fundamentally, the economic engine is just expected to run faster over there.
That's the core idea, the potential for faster growth. And the other big piece is valuation.
They look cheaper.
Significantly cheaper, according to the source, especially compared to the U.S. market. They mention the average price to earnings, or PE ratio, for the stocks held in EEM is around 11.7. Compare that to the S&P 500's PE, which was over 20 when they did the analysis.
So you're paying less for each dollar of earnings in EM on average.
Right. Lower PE ratios often suggest assets might be undervalued, or at least cheaper relative to places like the U.S., which have had strong runs.
Which ties into their next point about recent performance, doesn't it?
Exactly. They note that U.S. markets, particularly the S&P 500 and the tech-heavy NASDAQ, had seen really strong gains leading up to their analysis, like 16.5% and 32% year-to-date gains respectively as of mid-2025 in their example. U.S. stocks got pretty expensive. Emerging markets, meanwhile, have really lagged behind developed markets for several years now. They haven't seen that same kind of surge.
So the contrast is stark. U.S. up a lot, EM kind of flatter down.
Right. And this leads the TipRank source to frame EM as potentially a smart contrarian play, betting against the recent trend. They even use that phrase fire sale again, suggesting prices are maybe attractively low compared to history or the U.S. market.
Okay, so the pitch is faster growth potential, cheaper valuations, and maybe a chance to buy low after years of underperformance relative to the U.S. Makes sense as an argument. Now let's look at the two big ETFs TipRanks compares for accessing this, VWO and EM. What are the basics?
Okay, VWO is the Vanguard FTSE Emerging Markets ETF. It's the giant in the space, massive assets under management, around $72.8 billion, according to the source. It tracks an index from FTSE the FTSE Emerging Markets All-Cap China A Inclusion Index.
All-cap, meaning small companies too.
Yes, all-cap typically means it includes large, mid, and small-cap stocks. And the China A inclusion means it includes shares listed directly on mainland China exchanges. Its portfolio covers countries FTSE classifies as emerging, like China, Brazil, Taiwan, South Africa, India, etc.
Got it. And EM.
EM is the iShares MSCI Emerging Markets ETF, also very large but smaller than VWO, with about $20.3 billion in assets. It tracks a different index provider, MSCI, the MSCI Emerging Markets Index. This one focuses more on large and mid-sized companies in countries MSCI deems emerging.
Okay, so both aiming for broad EM exposure, but different index providers, FTSE versus MSCI, and slightly different size focus, all cap versus large mid. How similar are their actual holdings?
Well, in terms of the sheer number of stocks, VWO is way broader. It holds something like 4,680 different stocks. EM holds around 12,246.
Wow, big difference in number of holdings.
It is. Both numbers obviously provide a ton of diversification against single stock risk, but VWO definitely casts a wider net, including more smaller companies. However, if you look at how concentrated they are in their top holdings, they're actually pretty similar. The top 10 stocks make up about 20% of VWO and about 23% of EEM, so the biggest companies have a similar weight in both.
And are those top companies the same ones?
Largely, yes. You see a lot of overlap in the big names that dominate emerging markets. Companies like Taiwan Semiconductor, TSMC, the Chinese tech giants Tencent and Alibaba, the delivery platform Meituan, India's Reliance Industries, they feature prominently in both funds' top holdings.
So the main drivers are similar. What about countries?
Geographically, also quite similar at the top. China is the biggest weight in both, around 30%. India is next, somewhere between 15% and 19% in both. Taiwan is also significant, around 15% to 18%. So the big country exposures line up pretty well.
Okay. Similar top holdings, similar top country weights. VWO holds more stocks overall.
Yeah.
Where's the major difference at? There must be one.
Ah, yes. There is one really significant difference in the portfolio composition that TipRanks highlights. It's South Korea.
South Korea. How are they different there?
EM has a pretty substantial allocation to South Korean stocks, about 12.5% of its portfolio. Includes huge companies like Samsung Electronics, which is one of its top 3 holdings. VWO, on the other hand, holds 0 South Korean stocks. None at all.
Whoa, 12.5% versus 0%. That's a massive difference for funds tracking emerging markets. Why?
It comes down entirely to the index providers, FTSE and MSCI, having different opinions. MSCI, which EM follows, classifies South Korea as an emerging market. FTSE, which VWO follows, classifies South Korea as a developed market.
Seriously, just a different classification decision.
Yep, it's a classic example of how index methodology really matters. Because of that difference, EM gives you significant exposure to the South Korean economy and market, while VWO completely excludes it. It's not a minor tweak, it's a fundamental difference in the country exposures you get.
That really underscores how you need to look beyond the fund name and see what index it tracks and what that index actually includes or excludes.
Fascinating. Okay, what about performance? How have they done? We know EM has lagged.
Right. And neither VWO nor EM has exactly set the world on fire in recent years, especially compared to the U.S. market. The source gives annualized returns. Over the last 3 years, VWO was roughly flat, maybe slightly positive. EM was actually down about Medica 2.2% per year. Ouch. Over 5 years, VWO managed about 2.2% annualized. EM was much lower, only 0.3% annualized. And going back 10 years, VWO averaged 3.5% per year, while EM averaged 2.3% per year.
So VWO seems to have consistently edged out EEM in performance across those periods, though neither was spectacular.
Correct. VWO has had a slight performance advantage, but again, both significantly trailed developed markets. And that historical underperformance is kind of the basis for that contrarian, maybe it's cheap now argument the source mentioned earlier.
Got it. Okay, now for potentially the biggest differentiator, based on what we discussed earlier, fees. How do VW and EM compare on costs? This is where the difference is, frankly, enormous. And it's the main reason TipRanks reaches its conclusion. VWO, being a Vanguard fund, is known for low costs, and it delivers here. Its expense ratio is just 0.08%.
0.08%. That's really low, like $8 a year for every $10,000 invested.
Exactly. Just $8 per 10K. Now, compare that to EEM. Its expense ratio is 0.68%.
0.SX8. Wow, that's...
Yeah, that's $68 per year for every $10,000 invested.
So VWO costs $8, EEM costs $68. For broadly similar exposure, EEM costs more than 8 times as much per year.
That's the math. And the long-term impact is huge. TipRanks ran a simple illustration. Invest $10,000, assume a 5% annual return before fees for 10 years. The VWO investor pays about $103 in total fees over that decade. The EEM investor pays almost $860 in fees.
Nearly $750 difference just vanishing into fees on a $10K investment over 10 years.
It's a massive drag on your compounding. It really highlights why paying attention to expense ratios is so incredibly important for long-term investors. It's one of the few things you can directly control.
No kidding. Okay, fees heavily favor VWO. What about dividends? Do they pay out income?
Yes, both distribute dividends collected from the underlying stocks. And here, too, VWO had the edge at the time of the analysis, offering a higher dividend yield of around 3.5% compared to EM's yield of about 2.3%.
So lower fees and a higher dividend yield for VWO.
Based on the data in the source, yes.
Okay, let's sum up this VWO versus EM showdown. Both offer broad EM exposure. VWO holds way more stocks, including small caps, and crucially excludes South Korea because FTSE calls it developed. EM holds fewer stocks, large mid cap, but includes South Korea about 12.5% because MSCI calls it emerging. Performance-wise, VWO has slightly outperformed over 3, 5, and 10 years, but both lag developed markets significantly. And the kicker, VWO's expense ratio is dramatically lower, 0.08% and 0.680%, and its dividend yield was higher. Given all that, what was the final verdict from TipRanks?
Their conclusion was pretty decisive. They called VWO the hands-down winner, primarily because of that huge difference in fees. They argued the cost saving with VWO is just too significant to ignore when the core exposure is relatively similar, aside from that key South Korea difference.
Yeah, it's hard to argue against saving $60 a year per $10,000 invested, especially when performance hasn't justified the higher fee.
That seems to be their main takeaway. The fee difference is just overwhelming.
Okay, so what does this all really mean when we pull it all together? We've gone through quite a journey here looking at accessing global growth via U.S.-listed emerging market ETFs. We started with the basics. ETFs are generally great tools, cost-effective, easy to trade, good for diversification, managing that company-specific risk. Then we looked at how you actually build a portfolio with them, defining your goals, figuring out asset allocation, conservative, balanced, aggressive, picking a structure, or satellite maybe, selecting the funds based on cost and liquidity, and crucially, rebalancing regularly while trying to avoid common mistakes like overlap or chasing performance.
Built the foundation.
Right. Then we took that sharp turn into the unique world of emerging markets, risks, the currency fluctuations, the political instability, potential governance issues, liquidity constraints, stuff that's just Well, more intense than in developed markets. Higher potential reward, but definitely higher and different risks.
Absolutely key to understand that trade-off.
And we layered on that fascinating tax wrinkle from Fidelity, how EM ETFs might not be as tax efficient as you assume because of those in-kind transfer restrictions, possibly leading to internal capital gains distributions, unlike, say, an ETN structure.
A really important, often overlooked detail.
Finally, we brought it down to earth, comparing VWO and EM using tip ranks analysis. Similar goals, but different indices mean a huge difference on South Korea, similar recent performance struggles, but a massive undeniable difference in the expense ratio, which heavily favors VWO long-term, plus a better dividend yield.
It really paints a picture, doesn't it? The path into emerging markets through ETFs is definitely appealing that lure of growth, maybe finding value. But it's a path you have to walk carefully.
Right.
You need to be aware of that whole suite of extra risks, understand the specific tax implications might not follow the usual ETF rules, and really scrutinize the tools themselves, the underlying index, and especially the costs, like that VWO-EM comparison shows so clearly.
Just exactly. Investing in emerging markets isn't just checking a box for geographic diversification. It's a really complex decision. You're weighing that potential reward against significant, sometimes hard to quantify risks. You're navigating structural details like potential tax inefficiencies. And you absolutely have to focus on costs. So thinking about everything we've unpacked today, from diversification principles and portfolio building to the stark realities of EM risks and tax issues, and the concrete differences between funds like VWO and EM in cost and holdings, how might you, the listener, approach figuring out if, and maybe more importantly, how emerging markets fit into your bigger investment picture? How do you balance that potential fire sale opportunity against the very real heat of the risks involved?
It definitely gives you a lot to chew on, doesn't it? Something significant to think about for your own situation.